Hi, thanks for joining me. I'm Bri Lynch, Head of Market Insight at EquityZen. I'm here with Phil Haslett, Chief Strategy Officer and co-founder at EquityZen, and we're going to be talking about all the trends we've seen in the market in Q3 and really what this means as we look forward to the rest of the year ahead. So, Phil, thanks for joining me.
Good to be back.
We love these conversations. So, it's been an interesting year, certainly an interesting quarter. The IPO activity that we've seen has made this year actually the most active year for IPOs since 2021. But when we look at the current market right now with the government shutdown, some of that activity has slowed down. But, on a whole, we've seen that exit opportunities have increased demand for investments pre-IPO and investors who want to get access before that exit actually happens. So we're going to talk about that. We're going to talk about all the different trends we saw that have driven this market. So let's dive right in. One of the things that we've seen really is that investor interest in this market and activity really has surged. When we look at the first half of 2024 versus the first half of this year, Phil, we've seen transactions on EquityZen's platform actually double. So really seeing this risk on sentiment. What do you think is driving that? And, what do you see on both the buy side and the sell side of the market?
Yeah. Well, I think the first thing is a lot of people are starting to wonder if this is kind of 2021 enthusiasm all over again. And also, is this a bunch of people kind of just selling their positions the same way they were in 22 and 23 when things were a lot more distressed? And I think it's kind of neither of those. This is a combination of GPs and LPs of venture capital firms and seed stage funds locking in gains, and also that employees have seen material paper gains across a number of different companies that are looking to diversify and are probably seeing prices relative to recent rounds that they're more comfortable with or think are more representative of fair value and are finding eager buyers to do that. On the investor side, you've seen valuations grow significantly, and not just from 100 million to 3 billion, but from 5 billion to 50 billion to 100 billion. And so when you have a combination of companies that can grow to be very large, like I think we call them like decacorns, centaurcorns, whatever you want to call them, and you've seen private companies that can get to 100 billion, 200 billion, 500 billion, and you see publicly traded tech companies that are now eclipsing $2, $3, $4 trillion in value, it stands to reason that you would be more interested in making investments in kind of late stage tech companies, particularly now that we've seen the IPO window open up a bit, like you said, the most in the last couple of years. That all combines to have an investor have a thesis that says these companies can grow to much bigger than even where they are now. They can do it quickly, and they have a path towards exit. So my calculation on return and ROI and honestly IRR, because the time is shorter, just makes for a much more compelling case to put chips on the table.
Absolutely. I know we've seen from some of our one-off conversations as well, you talked about LPs and GPs rebalancing their portfolios. There seems to be a growing understanding from venture capital firms that they need to understand this market, if not participate in this market, understand the opportunities they're seeing on the buy side and the sell side and where they may want to act. How do you see that shaping the market as well?
Totally. The other thing I'd say too is VCs may not have gotten into the primary rounds for these companies they wanted to invest in because they're hotly contested. And you have more strategic investors like an NVIDIA or a Google or a Meta that are taking on the role of being a lead investor and, given their cash stockpile, have made very large investments. That's going to push out some VCs. So they're kind of coming to the secondary markets as well. And really what it is you kind of think that, like other cycles and where sectors are growing quickly, there's going to be a handful of winners. There aren't going to be 20. I think the running stat I heard was that its peak when LinkedIn was growing, there was something like 90 recruitment and like job networking sites, right? And there ended up being one winner. And so as an investor, you want to make sure you can get into the one or two that really matter, particularly in the late stage. And so it's not necessarily a chase, but it's more to maybe kind of a movement towards the best one or two in each space. And I think we're seeing that.
Absolutely. So talking about what's hot, let's transition to talking about some of the hottest industries. What our data has shown in Q3, which may not be surprising to most people, is that AI continues to be 8 quarters in a row the most popular industry. And it's followed closely by information technology, pure tech companies and fintech companies. These 3 industries have kind of led investor interest over the past several quarters. But we also see new industries really bubbling up to levels we haven't seen recently. So I want to dive into two of those industries in particular that have kind of made the map in Q3. And the first one being SaaS. I like to call it the sassy comeback because I love a pun. But SaaS is now the number 6 most popular industry amongst investors on our platform. Can you talk about what's driving that interest in SaaS and what overall trends are shaping the SaaS market?
Yeah. Well, first off, I commend you on yet another Bri Lynch portmanteau that will, enter the tech zeitgeist. The sassy comeback is real. We have seen the first wave we saw with SaaS, particularly over the last 2 years with the drive of generative AI was, oh my God, what's going to happen to SaaS companies? If you're able to build an agent that can solve your enterprise problems, what do you need vertical SaaS for, right? There has been an evolution since then to see that the best SaaS companies have embraced AI on their own and embedded it into their own products rather than getting gobbled up by or losing business to the Anthropics, OpenAIs, and XAIs of the world. So I think that's the first movement. The second is if you are a sector expert in your vertical, if you focus on enterprise SaaS for the healthcare industry, you know that space top to bottom, and you have clients that rely on you to know that space and your own necessities, right? HIPAA compliance or security levels that you need that may not be available in kind of the general generative AI offering. And so I think seeing companies successfully embrace that and have a specific AI solution built into their SaaS product for their type of clients has worked well, right? And I think that's led to a resurgence on our end. I think that's probably the biggest development.
Yeah, absolutely. And let's change gears to talk about another one of these industries that's really growing in popularity as well. Robotics. Robotics is now the number 9 most popular industry amongst our investors. Robotics companies have been making the news a lot, especially in the past 2 quarters. So how do you see this trend maybe about hard science or manufacturing vis-a-vis what we've seen in kind of like the AI world?
Yeah, I think it's driven by 2 things. One is that there are a lot of eyes on robotics in particular. And that happens when Elon Musk and Tesla talk about how humanoids are coming, right? That captures the attention of the masses. And so a byproduct of that is that if there are companies that are privately held that are working on robotic solutions and are showing progress and are probably accelerating progress because of AI for their own hard tech, that's going to command attention and probably interest and probably shorten the time frame that it might have taken to bring this technology to market to actually be useful. I think about when we started EquityZen in 2013, there was a lot of talk about autonomous vehicles. And there was a lot of investor interest. And then there was nothing to show for it for a long time, right? You didn't have Waymos driving around San Francisco in mass until, I don't know, maybe a year or 2 ago. But the idea had been there for over a decade. So if you were an investor, you might not have done that well. Humanoids are showing a lot more progress faster. I think that's the opportunity. And obviously, the addressable market for humanoids, whether it's within factories or in the home, are enormous. And so I think that's driving that a lot. And the second part on kind of hard tech is when you seem to have a national interest, whether it's a national security interest here in the US or support via investment into something like quantum computing, that will bode well and flow into the market as well, right? If the government is talking about how they're going to look to support, whether it's data centers or defense tech or quantum computing, that's a big sign of support and regulatory likelihood for harder tech. And so I think that's helping out as well.
Yeah, absolutely. That's a great point on the regulatory and that vote of confidence from the government that really tells the rest of the market that this is where the opportunities are. So we've talked a little bit about those hot industries. Let's zoom out and talk about valuations and what we're seeing in the market as a whole. When we looked at our data from Q3, we saw that only 14% of deals on EquityZen's platforms traded at a premium to that last round of funding. So when we talk about that, we're talking about the last primary round that company raised, their Series B, their Series C, whatever it might be. This is kind of a pullback from where we were last quarter, where more companies were trading at a premium and more in line with some of the historic averages we've seen. Another point on valuation that feeds into that is the fact that the average company last quarter traded at a 29% discount to their last round. So again, a larger discount than we saw in Q2. How do you contextualize that with what we're seeing in the broader market? When it comes to investor sentiment and, how they're ascribing value to these companies?
Yeah. Well, I think first it's helpful to start as kind of an anchoring point that, at its worst in 22 and 23, we saw discounts in the 50 to 60% range from previous round of funding, right? And now we're up to a 29% discount. So on a relative basis, we're moving up. As far as, why aren't we seeing as many premium deals? Why is the discount a little bit smaller? I would posit it's because companies are raising money again. There was a real dearth of capital raised in the private markets for late stage growth in 22 and 23, and honestly for most of 24, with the exception of kind of the biggest names we can think of, right? Like the blue chip, Mag 7, whatever you want to call them. However, in 2025, you have a cohort of companies that have been private for a while that have finally kind of righted the ship and have raised again. And so then you'll typically see somebody anchor off of probably a higher valuation at a discount versus a lower valuation from 2021 or 22 at a premium. That's piece one. And then piece two is that you've got new entrants into kind of the late stage space, the $1 billion plus valuations that are growing really quickly. And, we'll probably talk about this more, but companies that are going from inception to $1 billion, $5 billion valuations in a matter of years. And so those companies are raising money now, and therefore we're seeing deals trade at, sometimes a discount, or if the companies are showing growth even, a month after their recent round, you might actually see people willing to pay a premium for those companies as well.
Yeah, I think that's a great point there. And the activity that we're seeing in the secondary market really is a byproduct of activity that's happening in the primaries. That primary funding round is one of the main pieces of data that we have to inform secondary trades and where these companies are valued and what industries and companies are growing in the market. So I think that's a really good point about how that relates to how things are trading in the secondary market. When we zoom in a little bit, it's not a tale across industries where everything's trading at the same discount. There is divergence. For example, we've seen that all of the food and beverage companies that have traded on our platform in the last quarter traded at a discount to that last round. The more interesting point is the areas where companies are trading at those premiums, and industrial companies as a whole traded at greater premiums in the last quarter. We saw 56% of deals in industrial companies on our platform trading at premiums last quarter. So what's happening in the industrial space that you think is leading to the fact that these companies are trading above those last funding rounds more frequently?
Yeah, well, I think part of it is that industrial companies fit into that complex of sectors we talked about where there's a big focus on hard tech, right? And companies that have national interests. And so I think part of it is driving that. And the second I'd posit is that an industrials company will probably put in more work to get a round put together, right? Versus a SaaS company. There's a lot of diligence that has to be done on which contracts you might have at the government level, evaluating the physical assets you hold. And so there's probably a wider amount of time between funding rounds. So if you've got growth in the space and you have data points that are further apart, it stands to reason that, the company's going to go up in value, but there's going to be time in between. You'll likely see that on the way up, you're seeing things trade at a premium. I think that's probably the biggest driver. So it could be, you could call that like a stale valuation. And so therefore there's a premium to it. I think it's more that there's more time in between those two big data points of, how the company's performing. That extends into space tech, that extends into defense tech as well. And so I think that's why we're seeing it kind of in the industrials complex on our side.
Yeah, that's a great point. So coming into our last trend, and one that I think is really the most interesting personally, we've seen in the last quarter this surge in demand for companies valued at less than $10 billion. So relatively smaller companies than where we saw demand over the last few quarters. And that's coupled with a trend where there's greater investor interest in companies that are less than 5 years old. In fact, we've seen more interest in those younger companies than we've seen since 2018. So certainly something that's defining the market. It's these up-and-comers where investors are looking to see new opportunities after the centacorns have been in the market for a while. Maybe there's a question of how much growth or upside is left even in the private markets once you achieve those types of valuations. So can you talk about that a little bit of why investors may be moving earlier or smaller in the market to look for growth?
Yeah. Typically, investors on our platform wouldn't be that interested in a company that's, only 2 or 3 or 4 years old, right? And there's two reasons for that. One is there's not much to say about the company because it's pretty early stage. They wouldn't have had much revenue to speak of, probably had spent too much time marketing. So you just wouldn't really be aware of them. And the second part is that if your company's only a few years old, there might not be that many people looking for liquidity, right? Because you've only been working on this for a couple of years. We tend to see the pent up need for liquidity when a company is 7 or 8 or 15 years old. There's a fully rational reason why there's a lot of people that want to sell shares of a company when they've held for that long, even if the company's performing great. What's transpired over the last few years is that, particularly with the advent of AI, you can build a company and scale it incredibly fast, right? I think Lovable is a great example of a company that went from pretty much idea to $2 billion valuation with $100 million in revenue in something like 12 to 18 months, right? And that was completely unheard of. We had seen a version of this in 2013, 2014, where we first started, not at the same scale of revenue, but on driving down the cost to start a company. Once you had cloud services and didn't have to have servers to build out your business, and you could host on AWS or Azure, we just could get up and running much quicker with less capital needed. This is a new version of that, which is companies can get up and running fast. That's not new. Companies can scale revenue fast because they could deploy a product into the market and start earning revenue on that really quickly. But the caveat emptor I'd say on this is that these companies are scaling really fast on the top line. And it's unclear so far on how good of margins these companies are having, because they're ultimately reliant on spending a ton on computing power related to, the large language models they're relying on. They may be running everything through ChatGPT or through Claude or through Perplexity or through XAI and paying up the nose for it, right? So it might be that the $100 million in revenue for this company only has 30% margins instead of your classic kind of SaaS model where you have 70 or 80% margins. So very excited to see how it shakes out, but it's been kind of mind-blowing to watch how quickly, each week it seemingly seems like someone's like, we're the fastest to 100 million in ARR. And that number is real. It's just whether it's a sustainable business model for them as they scale.
Absolutely. That's a good point. Margins matter.
Margins matter.
We'll see how this plays out over the next few years. Certainly feeling a little frothy with some of these AI companies, and there'll be winners and losers, and especially as people move earlier in the market, but interesting to watch. We look at on our platform, the companies that have jumped to popularity out of seemingly nowhere. It's what we call our movers. We look at our monthly movers, our quarterly movers. This quarter, it was interesting. The mix of companies really spanned a lot of different industries. You had Mercor as the top quarterly mover, Wave, Hadrian, Gecko Robotics, Postman. I won't give the whole list, but looking at this list of companies, any jump out to you in particular or anything that you think that's worth noting?
I was frankly surprised too, right? And this is why it's, the data doesn't lie, but it really is kind of a hodgepodge of industries. And I think it's reflective of the fact that there are starting to be winners that are emerging across each sector, whether it's because they have an AI strategy that they've perfected, whether it's that they're in the robotics industry and there's a lot of growth signal, or they're in the defense industry, or it could be really, really idiosyncratic, right? That a company worked in a space and their main competitors, had some foot faults, and all of a sudden that they've been able to capitalize. So it's a bit of a mix, but again, I think it kind of shows that we're starting to see some winners emerge and that we're in a pretty healthy market for companies to raise capital, right? And to garner more investor interest, with, again, keeping a close eye on how frothy are we getting, how close to peak are we getting.
Absolutely. So we've covered a lot of ground. We talked about the industries that are trending up in the market, valuations coming back to some of the historic norms we've seen, the industries where there is still upside valuations versus those last rounds, and the areas where investors are looking for opportunities and growth. So as you look at this as a whole and you look forward through the last few months of this year and even into 2026, is there a trend you're watching or something in the market that's you're really keenly focused on?
I want to see if the IPO window fully opens up. I think we got a good glimpse of it in 25, right? The most active in a few years. But it seems to me like there are a lot of companies that have a decade old, great businesses have talked about an IPO for a while that we didn't see come public in 2025. And as we kind of get towards the tail end of 2025, we typically see the IPO calendar seasonally slow down. No one really wants to go public between Thanksgiving and the holidays. It's a relatively slow time for Wall Street. So I'm really keeping an eye on, are we going to come flying out the gates in January after the new year? And if we do, I think that will lead to even more activity on a place like EquityZen or just generally in the private markets to show that there is an exit path, and it wasn't a bit of a one-off with Klarna and Figma and Circle and CoreWeave, that it's more of a sustainable exit path. That's what I'm keeping a really close eye on.
Absolutely. We'll be working on our IPO outlook over the next few weeks. So a nice plug. It's been a really interesting quarter in the market. Secondaries as a whole, we're just seeing so much more validation, across participants on the buy side, on the sell side, from companies themselves who are, embracing this as a lever to enable their growth while they stay private, and a lot of exciting trends to follow. So thanks for joining us, everyone. And we'll be back to share the latest insights soon. But in the meantime, you can visit www.equityzen.com/investor to learn more about investment opportunities in this market. Phil, thanks for joining us.
Thanks for having me. Always fun, Bri.